May their souls continue resting in eternal peace. Thank you, honorable members. Mr. Speaker, no life should be lost and no property should be destroyed again. The message from Kenyans was clear. Since I took office at the National Treasury and Economic Planning, I assured Kenyans that we shall strive to reduce tax burden. In this respect, the Finance Bill of 2025 has neither proposed new taxes nor raised any tax rates. Instead, we have chosen to enhance tax revenue collection through administrative reforms by simplifying and streamlining tax laws to make them clearer and easier to implement, thereby by improving taxpayer compliance. The process also involves rationalization of tax expenditure to enhance equity and fairness. Mr. Speaker, the revenue foregone through tax incentives or tax expenditure has increased significantly, rising from Kenya shillings 393.1 billion, which is equivalent to 2.9% of GDP in 2022, to 510.6 billion, which is equivalent to 3.4% of GDP in 2023. To reverse this trend, the Finance Bill of 2025 proposes reforms to rationalize tax expenditures so as to promote equity, fairness, efficiency, and reduce distortions within the tax system. The proposed reforms are in line with the national tax policy and the medium-term revenue strategy, which this Honorable House passed. So, Mr. Speaker, from the proposed reforms, we expect to raise Kenya shillings 30 billion more as additional revenue. Mr. Speaker, customs measures agreed upon by East African community ministers during the pre-budget meeting are intended to protect our industries and ensure they access raw materials and inputs at affordable prices. The meeting allowed Kenya to import tea packaging materials at a lower duty rate of 10%. In addition, Kenya was granted an extension of duty remission to import wheat at the rate of 10%. These measures will support our wheat and tea farmers. Mr. Speaker, I will begin with the customs measures and later provide highlights on the proposed amendments of tax laws in the Finance Bill of 2025. On customs measures, to meet the local demand of rice, Kenya was allowed to extend the stay of application on the East African Community Common External Tariff and import rice at the rate of 35% or USD 200 per metric ton, whichever is higher, instead of the common external tariff rate of 75% or USD 345 per metric ton. Mindful of wheat farmers in Kenya, East African community ministers agreed on duty remission of wheat at a rate of 10% instead of the common external tariff rate of 35%, provided the millers who intend to import wheat under the duty remission must first purchase locally produced wheat. Mr. Speaker, to promote local assembly of telecommunication equipment, Kenya was granted an extension of duty remission on inputs for assembly of telecommunication devices, including mobile phones, laptops, and tablets. Mr. Speaker, in order to reduce the production cost of animal feeds, Kenya requested for an extension to import inputs for production of animal feeds duty-free under the East African Community Duty Remission Scheme, which was granted. We urge the producers of animal feeds to apply for the remission. Mr. Speaker, the leather sector is one of the priority value chains under BETA. To support local producers of leather and leather products, Kenya was allowed to extend the stay of application on the common external tariff rate and apply import duty rate of 35% on leather products. To promote tanneries to supply local manufacturers with high-quality leather, Kenya was allowed to import chemicals for leather processing under duty remission. Mr. Speaker, to support local assembly of transformers, which is critical to energy distribution, the East African Community Ministers approved Kenya's request for a tariff split on transformers to provide for a distinction between fully built and unassembled transformers. Currently, it is one line tariff line, and it is very difficult for us to separate and incentivize either of them. So, Mr. Speaker, to support the local assemblers of cranes, Kenya was granted approval to import inputs for assembly of cranes duty-free under duty remission. Mr. Speaker, last year Kenya was granted a stay of application on the East African East African Community Common External Tariff to apply a higher duty rate ranging from 25 to 35% on certain types of paper used in manufacturing packaging materials. This action adversely affected exporters, particularly in tea sector. To address this, Kenya opted not to request for an extension of the stay of this common external tariff. And this decision will not affect local manufacturers of packaging materials, as they will continue importing raw materials under duty remission. So, Mr. Speaker, now let me speak to the Finance Bill of 2025. Let me now highlight some of the proposals contained in the proposed Finance Bill 2025. Under Income Tax Act. Mr. Speaker, to enable faster recovery of investment by businesses on loose items such as utensils, linen, and industrial tools, the bill proposes to amend the Income Tax Act to allow for a full cost deduction of these items in the first year of purchase, as opposed to the current 3 years. This will improve cash flows of the relevant businesses. Mr. Speaker, we have noted increased tax disputes arising from audits carried on cross-border transactions. These disputes could have been avoided if the multinational companies had advanced pricing agreements with the commissioner at KRA. To address this gap, the bill is proposes to amend the Income Tax Act to empower the commissioner to enter into advanced pricing agreements with multinational companies. Mr. Speaker, the Tax Laws Amendment Act of 2024, passed in December last year, introduced the minimum top-up tax in line with the global best practices. But the Act inadvertently omitted the due date for payment of the tax, thus creating enforcement challenges. To address this, I have proposed an amendment to the Income Tax Act to clarify that the due date will be the end of the 4th month following the close of a company's accounting period. Mr. Speaker, again, the Tax Laws Amendment Act of 2024, passed in December last year, exempted gratuity payments from income tax, actually pension and gratuity. However, the provision is not clear whether all gratuity, including from private pension schemes, is exempted from tax. In this respect, the bill is proposing to amend the Income Tax Act to clarify that all gratuity payments, whether from public or private sources, are exempt from tax. Mr. Speaker, to encourage wider participation in virtual asset transactions, especially among the youth, the bill proposes to reduce the digital asset tax rate from 3% to 1.5%. And Mr. Speaker, to ensure consistency and effective administration of the law, the bill proposes to amend the 3rd schedule to the Income Tax Act to clarify that fringe benefit tax is payable by the employer at the corporate tax rate, and that withholding tax on qualifying dividends and qualifying interest are final tax. That is not clear in the current arrangement. And Mr. Speaker, under the current Income Tax Act, individuals with mortgages, and honorable members would be interested in listening to this. Mr. Speaker, under the current Income Tax Act, individuals with mortgages for purchasing or improving residential houses can claim tax relief on interest payment on the mortgage. However, those who take up a mortgage to construct their own residential houses are excluded from this relief. That is the law as it is today. To ensure fairness, the bill proposes to extend this benefit to interest on mortgages taken for construction of residential houses. This will support home aligned with the better pillar on affordable housing. Mr. Speaker, the current tax-free daily subsistence allowance of $2,000 for private sector employees on official duties outside their usual workplace is lower than that of the public sector employees. To enhance equity, the bill is proposing to increase the tax-free daily subsistence allowance for private sector employees from 2,000 to 10,000 shillings. Mr. Speaker, Kenya has an opportunity to strengthen its position as a regional financial hub. In this respect, the bill proposes amendment to the Income Tax Act to provide that companies certified by the Nairobi International Financial Center Authority, NIFCA, that invest new capital of at least 3 billion over a period of 3 years to pay a reduced corporate tax rate of 15% for the first 10 years and 20% for the subsequent 10 years. The companies qualifying for this will be required to employ Kenyans at senior management level. The startup companies that are certified by Nairobi International Financial Center Authority will enjoy a 15% tax rate for the first 3 years and 20% for the subsequent 4 years. And dividends earned by certified holding companies and regional headquarters will be exempted from tax, provided that at least 250 million is reinvested annually in Kenya. Mr. Speaker, we have noted that some employees seek refunds from KRA on reliefs of deductions that ought to have been deducted by their employers. To address this challenge, the bill proposes to amend the Income Tax Act to make it mandatory for employers to consider all eligible tax reliefs and deductions when computing employees' income tax. Presently, employers are not compelled to deduct these reliefs in computing pay as you earn. Value-added tax. Mr. Speaker, while a supplier is required to issue a tax invoice at the point of sale, there is currently no definition of tax invoice under the VAT Act. This creates ambiguity on what constitutes a tax invoice. To resolve this ambiguity, the bill is proposing to amend the VAT Act to define a tax invoice. Mr. Speaker, to strengthen tax administration and enhance compliance, the bill proposes to require the issuance of tax invoices for all suppliers, whether taxable or exempt. This amendment will support better record keeping by taxpayers and facilitate the pre-population of returns. Mr. Speaker, to support business operations, the bill proposes to shorten the period for claiming refunds on bad debts from 3 years to 2 years, and to allow taxpayers to either request for a refund or offset it against future VAT liabilities. Mr. Speaker, again, entities in special economic zones currently benefit from VAT exemptions and zero rating, but there is no provision to recover tax when these benefits are misused or abused. To safeguard revenue and promote accountability, the bill proposes to recover VAT where exempted or zero-rated goods or services are used for purposes other than those intended. Mr. Speaker, to prevent leakages or revenue leakages, move some zero-rated goods and services that are consumed locally to exempt status. Further, Mr. Speaker, some of the goods exempted from VAT have multiple uses, making it difficult to effectively monitor whether they are finally used for the intended purpose. In this respect, the bill proposes to amend the VAT Act to remove such exemptions. Under excise duty, Mr. Speaker, to minimize tax disputes relating to